Hey, this is Wayne Wagner from Visionary Wealth Management, and everybody's talking about Silicon Valley Bank, so we will too. Here's a microcosm of what happened with Silicon Valley Bank. Silicon Valley Bank is just like every other bank. They're highly dependent on two things: steady, sticky, predictable deposits and the valuation of their loan portfolio. And so Silicon Valley Bank has a particularly challenging business model because what they do is, as a bank for Silicon Valley companies will go out and get $1 billion in financing, and they'll come deposit it with Silicon Valley Bank. And then they'll immediately start paying people out of that and spending money like drunken sailors, like startups do, and running their business. But they're spending down that capital. That means that Silicon Valley Bank's deposits, which have tripled in the last 4 years, so that's very good, but those balances are very not sticky, meaning that companies basically deposit a bunch of money and then spend it down over time. And then there's another company that comes in, deposits a lot of money, and then spends it down over time. So their deposits are particularly volatile. On the other side is the valuation of their loan portfolio, which is dependent upon long-term interest rates. So think about if they loaned out 10 times their deposits, which that's what banks do, is they loan out about 10 times their deposits. If they loaned out 10 times their deposits and then suddenly interest rates went up by 4 or 5% on a bunch of 30-year mortgages, all of the equity in the bank could be gone in a moment. And that's what happened to Silicon Valley Bank. That's why they've been shut down, because they already had a rather unsticky, rather volatile business model for where their deposits were coming from. And they put the lion's share of their long-term loans in 10-year government bonds. Now, 10-year government bonds, a year and a half ago, when they started doing this, were paying 1.5%. And so they loaned out, they bought a bunch of assets in the form of their loan portfolio that were yielding 1.5%. Well, they were not anticipating that interest rates would go up by 4 or 5 percentage points on that portfolio over the course of the last year, which caused a significant drop in the valuation of those bonds, the valuation of those loans that are assets on their books. And so what they ended up doing was they had an unsticky loan or deposit portfolio and an extremely volatile loan portfolio. The guy who was their chief risk person was involved in Lehman Brothers before they crashed. And so I'm not sure who put that guy in charge again of a $200 billion plus organization, but he's in charge again, so maybe this time he'll retire. Anyway, I digress. So what they did was they decided to sell off some of their bonds at a loss and issue more stock to improve their capital situation and their risk return profile on their portfolio. Well, when that happened, a bunch of their depositors came out and said, the FDIC only insures up to $250,000. We've got $900 million in deposits with this company. Maybe we should diversify how many banks we have our cash in. And so they went, a bunch of their depositors showed up in a really short period of time and said, hey, we've decided we want to work with 6 banks, not one. So we want 90% of our money out. Well, that's a run on the bank. So in the midst of this chaos with a declining value on their loan portfolio and already unsticky deposits, a bunch of their deposits went away really fast. That's what caused the cash crunch. That's what caused for the regulators to come in and close down Silicon Valley Bank. And all bondholders and all stockholders of Silicon Valley Bank are going to be completely wiped out. So there's a lot of rules and lessons here. Diversification, key number 1. Number 2, how banks manage their risk overall is really important. Number 3, big question on everybody's mind right now, is this a Lehman Brothers moment? Even though there's that one guy who's probably going to lose his job again. But seriously, is this a Lehman Brothers moment? Short answer, we don't know. We think that there will be other banks that get whipsawed like this. We think that many of those banks and their boards are taking a lot of notes right now to try to study this and figure out how not to be next week's SVB. So nobody wants to have their acronym up next to the word contagion in a headline. So everybody's trying to avoid that. But that's a little bit of the background on what happened with SVB, how it happened, why it happened. Here at Visionary Wealth Management, we're always here with perspective for the decisions ahead. Call anytime. Have a great day.